A lot has changed in the markets over the last week. 5 indicators that we follow all turned red Thursday afternoon. And we'd been enjoying an extended rally coming off the April lows from the Liberation Day tariff scares. And some indices are up 20-30% or more. But now all the data seems to be turning decidedly negative. Some of the smartest CEOs and money managers had already started to reposition portfolios, and the value investors had already been sitting on a lot of cash. But the momentum investors were almost entirely invested going into last week, but now some of this is starting to change. In this video, we're going to go over the actions of some of the biggest actors in the market, and they can't change things too aggressively or too easily. The sharks can. The smart, nimble investors can change things on a dime, but the minnows and the plankton, they tend to get eaten alive. We're going to be going over the 7 short to intermediate term indicators that we follow to help us determine some of these turning points in the market when the momentum is shifting. And we're going to go over which indicators were already negative and which turned negative just last week. There's one that hasn't given a warning yet, but in going over these 7 things, we want to explain a little bit about what we look for and what actually caused the market to get the jitters over the last week. My name's Joe Franklin, and here at the Mustard Seed, we like to put faith with finance. And we care more about what the word says than what ChatGPT says about finance. And today, we're going to be covering momentum and when the momentum is changing and what we can see as far as these outside forces causing things to change in the markets. So last week, we had some bad earnings reports out of companies like Amazon and Coinbase and some others on Thursday evening. There were some mixed results that came out, but what really spooked the market was what happened with the jobs numbers. The jobs numbers were revised down for May and June pretty aggressively. The July numbers weren't all that great either. That sent the market into a tailspin. The smart investors, a lot of them had already been sitting on a lot of cash. Warren Buffett is widely considered as one of the smartest investors who ever lived and the most successful investor who ever lived. And he's sitting right now on likely over $350 billion of cash in short-term treasuries. That's more than the Fed owns. Now, he's about as bearish as he ever gets. But the thing that's different about Warren Buffett, or you and I, or just about anybody else, is it takes him a lot longer to make moves. And he's got this big aircraft carrier that he's got to move around and reposition. And when he wants to deploy some cash, he's got to make some big purchases. It's not easy for him to be selling and repositioning the portfolio. If you're investing millions of dollars, you can make a change in the portfolio in minutes or an hour or what have you. If you've got hundreds of millions of dollars, it might take you a few days. If you got hundreds of billions of dollars, it might take you a few months. And so for Warren Buffett, it takes him a little bit longer to make these changes in the portfolio. Whereas others who are not as big, they can make changes a little bit faster than the big whale and Warren Buffett. Some of these sharks that are more momentum investors, they just got almost all their cash invested. Right now, the average mutual fund is sitting on less cash than they usually hold. And when cash gets down under 4%, that's usually not a good sign because there's not any more that they can be buying. And so that's what we've been seeing over the last month or so. We also want to note that valuations are about as expensive as they ever get. According to the Warren Buffett Indicator, which measures the total market capitalization of the market versus the gross domestic product, we've never been more expensive than we are right now, going all the way back to the 70s. Even during the dot-com boom, we weren't as expensive as we are right now. Benjamin Graham used to say that we wanted to look at what Mr. Market was doing. So when Mr. Market walked in and he was depressed and he wanted to sell things to us at a really low price, we could buy from him. Or when Mr. Market walked into the office, he was super excited and he wanted to buy things from us at a super high price, we could sell it to him. And so we want to do that with Mr. Market, but we also keep in mind that Mr. Market can get more and more excited over time. We want to get an idea for when he's going to be the most excited and is starting to change versus when he's the most pessimistic and he's starting to change. What we want to note is that the market can be overvalued but still keep going up, especially when investors have been trained to just put money in index funds and 401ks and whatnot. You've got forced buying in the market when people are doing that, and they've been trained to do that. So the minnows have been trained to do that, and the sharks are running around seeing where they can take advantage of this. But what we want to also note is that Newton's laws of motion apply. An object in motion tends to remain in motion until it's acted upon by an outside force, and this momentum works until we have these outside forces working upon the momentum and the trend changes. The key is seeing where the turning points are. The markets are going to fluctuate, but over time we can get a feel for what's going to happen on a yearly basis. A lot of times we can follow just the calendar and see that the best months to be invested tend to be October, November, December, January, March, and April. If you had February in there, you got 6 in a row. The very worst months to be invested tend to be the other months, and of those, August and September are the very, very worst. And so a lot of people say to sell in May and go away, but lately it's been more like sell toward the end of July going into August and go away, because August and September are the very worst months. This is playing out this way again this year because coming out of April, the market was really, really depressed, and so we got a good run from April through the end of July, but now it's starting to look like the party's over in the markets. You can see that in August and September, this plays out not just in the US markets, but in markets all around the world, where August and September are the 2 worst months to be invested. So just judging on this, we want to be getting out of the markets typically before that happens. Howard Marks likes to take advantage of things that happen in the market that are outside of the fundamentals of the market. And what he's noting are forced buying and forced selling. When the market gets the most pessimistic, you've got some people that are out there that have been borrowing to buy. They're out there on leverage, and they may be forced to sell. And he notes that the very best time to be buying, we've got forced sellers out there. When you flip this around, the very best time to be selling when there are forced buyers out there. So with the people that are buying into index funds and 401ks, that's when the forced buying is. Also, when they've got a short position, that means that they've borrowed to sell and they're forced to buy. That's a really good time to be selling to those people when we've got what's called a short squeeze. Breadth in the market gives us a really good idea of when things are really, really low and unlikely to go any lower. Let's take a look at what breadth actually means. What this chart here shows are all the companies that are trading above their 50-day moving average in the New York Stock Exchange. So when we've got a lot of companies trading above their 50-day moving average, that means we've got good breadth. When we don't have hardly any companies trading above their 50-day moving average in the New York Stock Exchange, that means we've got really, really bad breadth. When the breadth gets really, really, really low, that is the very best time to be buying. And we saw extremely bad breadth coming out of the pandemic in March. That was one of the very, very best time to be buying over the last 6 years or so. And the lowest the breadth has been in the last 5 years was in April, when we were going through the Liberation Day scare, and we saw these breadth numbers that really got me salivating at the time, wanting to buy. And so that was a really good time to buy. And we've seen a nice rally since then. The breadth actually peaked in June, and it's been going kind of sideways since then. But here last week, you can see that we had this trend line in the green there, where it looked like the breadth might keep moving up. But toward the end of last week, that trend line was broken and the breadth completely fell apart. And that's one thing that gave us a lot of pause toward the end of last week and made us want to be looking to free up some cash. Also, you can look at the alternative assets and see that breadth in alternative assets peaked in mid-July. And since then, the breadth has been coming down. And that also gave us a little pause as it relates to alternative assets. But we also want to look at things like volatility. That measures the amount of fear that's out there. When fear is the highest, that's the very best time to buy. You can also see here that in April the fear was really, really high, and so that was a good time to be buying. Here recently the fear has been moving up, and when we start to see this fear moving up, that's usually a sign that we want to be freeing up some cash. And so toward the end of last week, again, that gave us an indicator that we wanted to be freeing up some cash. When we look at alternative assets, you can also see that the fear gauge The greed is coming down, the fear is rising. That means that this is coming down, and so there's less and less opportunity to be getting on the bandwagon for more momentum going forward. So one other thing that we like to look at is sentiment, and sentiment is a contrarian indicator. And when we say contrarian indicator, we mean that we want to go against what most people are doing. And so what this sentiment indicator shows is when the people are the most bullish or the most optimistic about the market. And when they were the most optimistic over the last year and a half was in July of 2024. And that was a great time to be selling. We look back at April, and you can see that right at the beginning of April, that was when the average person was the most pessimistic or bearish, and that was a great time to be buying. So right now, the sentiment is indeterminate. We're kind of right in the middle. It's neither great nor really bad. So that is one indicator that's not really telling us much, but it's something that can tell us something pretty good as to what to do from time to time. We want to be following what the smart money is doing. People like Warren Buffett may give us an indicator for how expensive the market is long before the market actually tops. And CEOs, they're more like sharks. They can move a little bit more easily in and out of the market. So we also want to follow what the CEOs are doing. And so when we look at what CEOs have been doing, they have been selling primarily. There are periods when they've been buying. You can see on this chart that in 2020, for every one person that was selling, there were over 2 CEOs that were buying. So it was a 2-to-1 ratio of buying to selling back in 2020 during the pandemic. But here recently, for every 1 CEO that's buying, there's about 6 that are selling. And so that's about as low as we've been over the last 10 years or so. And so the CEOs feel like the market may be a little high right now, probably not a good time to be buying. And so this is what the smart investors are doing. And so this was showing that it may be time to be starting to free up cash a little bit earlier than just last week. We were seeing this indicator showing a sell a little bit before last week. When we look at what bonds are doing, that can also tell us a little bit about what we want to do with the portfolio. So bonds and stocks tend to move together when the market's doing well. So if bonds are moving up at the same time the stocks are moving up, that's usually a good sign. If stocks are moving up and bonds are moving down, that's not necessarily a bad sign, but that may be telling us that since the bond market and the stock market have uncoupled, that it's going to continue to uncouple, and we want to watch what the bonds are doing, because when the bonds start moving up, that may mean that the stocks are going to be moving down. And you can see from this chart that there's a lot of periods where you can lose money in the stock market but make money in the bond market. And during these times of uncoupling, that's the time when we want to be starting to own bonds. And earlier this year, and part of last year as well, the bond market uncoupled from the stock market. And going into Liberation Day, the bond market had actually been doing pretty well. Coming out of Liberation Day, the bond market was not doing well. We're looking for these outside forces that are causing the trend to change, and so this is one more thing that is saying that the trend may be changing. What we want to note is that during the really bad periods, that bonds tend to do well, and that's when the bonds uncouple from the stock market. When the stocks really sell off, the bonds move up because of the fear. Everybody wants to own bonds and be in a place that's safe, and of course the Fed's also lowering rates. That causes the value of the bonds to go up. But gold also tends to go up during these periods. So far this year, gold has done better than bonds. A lot of people are saying that nobody wants our bonds anymore. The U.S.'s bonds aren't any good anymore. But it may be that the Fed is going to be buying a lot of our bonds coming up pretty soon as more of these Fed governors get on board lowering rates and doing things to stimulate the economy. That is really good for the bond market. Not necessarily so good for the stock market, but it's really good for the bond market when that starts happening. When we're looking at these indicators, we've already seen a lot of long-term indicators that have been in the red for quite a while. Almost all the long-term indicators look really bad. But just last week, market breadth went to the red. Stocks versus bonds, the correlation on those went into the red. Momentum went into the red. CEO purchases were already in the red, so that didn't change. We went into the really bad period of the market. It's not determinate on the sentiment yet, but it may be the sentiment starts to look worse going forward. With volatility, the fear was ramping up. And so when we look at these things, it looks like the outside forces are acting upon the market to get us to change direction. And when you catch this thing early, that's what we want to do, is look at changing the portfolios before things get nasty. Warren Buffett has already moved to protect his portfolio many, many months ago. The CEOs were doing this over the last couple of months. And now it may be that everyone else may be wanting to make these changes before things get really nasty and protect your portfolios, make money in gold and bonds while we're waiting for much lower prices to come. So if you like this video, please feel free to click on this video here, and we'll catch up with you next time.